Hey guys, and welcome back to the Young Investors Podcast. We're at episode 32, and joining me, as always, is the one and only Brandon. How are you?
Woohoo!
How's the leg, Brandon? Is it healing?
Yeah, it's getting there. I went to the physio. Apparently, it's just it's now feels just like a grade 1 MCL, but I could have told myself that, but that's okay. It's annoying because I had to do like workers' comp because it happened at work, so I have to go through that whole process, get a claim number, blah blah blah. Just so much, it takes so much time. But overall, it's getting better. I'm feeling much better. My knee is almost 100% again. I did like a cycle class a couple of days ago, and that was the true test, but it actually held up fine. So
That's good.
yeah, I'm feeling good. Just keep it taped up. Anyway, that's not what we're supposed to be talking about. What are we talking about today?
Today, we are going to be talking all about Warren Buffett.
Woohoo!
So what we thought we would do is we just jotted down a bunch of probably the more popular quotes that you would have heard from Warren Buffett, and we're going to explain them. We're going to go through and interpret what we think they mean, and where they sort of originated from, and just give you basically a nice podcast about Warren Buffett's philosophy, because a lot of his philosophy really is driven from some of these quotes that he just repeats over and over again, isn't it?
Yeah, basically. I mean, there's ones that he says that just are true. They just stand the test of time because they're just so true, and all the best investors always end up using these quotes, and we'll go through them. Yeah,
and of course we'll start off with the indices. So we'll go through the major indices in the US and Australia, and we've got a couple of interesting news stories to go through, and then we'll jump into the middle section, and at the end we'll do some Q&A. And of course, if you have any Q&A questions for next week, then make sure you leave them below the comment section of the YouTube video, which is on my channel this week, Hamish Hodder.
Yeah. Also, just let us know what you want us to talk about. Just
give us topics.
Yeah, like if you want us to discuss something in particular, just let us know. Just write a comment, and we can make a podcast about it if it's if it seems like an interesting topic. All right, let's get into it. I'll run through the indices first up.
Go for it.
It was a bit of a kind of up and down week. It was more down than up, though. We got over in America, the Dow Jones was down 0.8%, NASDAQ down 0.8% as well, S&P 500 down 0.9%. Here in Australia, we've got All Ordinaries down 0.5%, ASX 200 down 0.4%. So overall, like nothing dramatic. You remember like late last year, we were getting these weeks where it was like Dow or NASDAQ were down like 4.5%, 5%. We're like, oh my gosh. In the last little while, it's just been a whole lot of nothing.
Yeah, we've kind of sunk back into a no volatility, just upward trend, at least from the end of the end of last year. It's just been a straight rocket upwards, so it'll be interesting to see when that volatility returns. But speaking of volatility, the first news story we've got here is that Uber had their IPO, their initial public offering.
Speaking of volatility, so true though. Sorry.
Yeah, so Uber, I'm sure many of you know what Uber is. They're the ride-hailing company, and essentially they had their IPO. They had the initial public offering. They IPO'd at $45 per share, US dollars, and they're trading at now, I believe, around $42 per share, which gives them a market capitalization of just under 80 billion.
Yep. Yeah, it's crazy. And last year people were saying it was worth like 120 billion, 130 billion. It's like, what the hell?
Yeah, it came down massively from what management was initially expecting to get. I think the first range they were giving was in the 50s, and then they dropped that down and they said we're going to IPO in a lower range. But they said probably at the top of they gave two numbers. One was 45 and the other number was 54 or something. And they said, probably at the top range of that. And then they IPO'd at the bottom range. And now it's even below that, which is, it's a dramatic drop from what they were expecting to raise.
Yeah, it dropped 7% in one day. So just on their first day of trading, dropped 7%, was down from $45 to, I think, it closed at $41.57, which is US dollars, that is. So, pretty crazy. And I mean, this is it's been a trend. We've had Lyft, which had their IPO. We've had now Uber. which had their IPO. Personally, I'm not a huge fan of IPO investing. And the reason people like tell me and comment all the time, like, oh, you should do videos on the upcoming IPOs and whether you'll be buying in. But that would just be a terrible idea because I'm never buying into any of the IPOs. And the real reason that I don't invest into any IPOs is because the strategy that we both follow is about having lots of kind of long-term data, financial data on how the management's performed and, the earnings per share and all that sort of stuff and sales growth and equity growth and all that sort of stuff. And with an IPO, it's an initial public offering. So you just haven't got that same level of detail into the financials to be able to base any sort of investment decision on. So it just makes valuation very, very hard to get right. Like too hard for me to try and do at all. Like I'm basically every IPO, I'm just like, nah, I pass because I just can't value it properly. What do you reckon about IPOs?
Yeah, well, I don't know about you, but I like to invest in companies that make money.
Yeah, true. That's another really good point though.
Yeah, I mean, Uber just, as you said, no track record. We don't know how they're going to perform in the future. They're not making money. Management has said they're not going to make money for the foreseeable future. As a shareholder, that means that the only way you're going to make money is by speculating on stock price increases, not by the company actually producing profit and returning that profit to shareholders.
Yeah, it's crazy. Like not even profitable companies, and they say they're not going to make money in the near term. And from the way I see it, this is just my perspective on the ride sharing kind of industry, I guess, is that I think that all of these companies are just going to be put out of business by Tesla. I just think Tesla is just going to smack them stupid. Like, basically, I reckon, although it seems like a long shot, it seems a bit strange that I think that, but especially just because Tesla, you just know them as like, they just build electric cars and whatever. But with their plans to build a autonomous network, a Tesla ride-sharing autonomous network, and the fact that they are like so far ahead in terms of autonomy, like in terms of their systems and whatever, and the fact that no other ride-sharing service is able to use the Tesla ride-sharing service in their own company, so that's like a clause as a part of ownership of a Tesla. So you say the only way that you can use this in the ride-sharing network is through the Tesla ride-sharing service, where Tesla takes like 30% of the revenue or whatever. So Tesla's got by far the best autonomous driving software, by far the safest. So they're going to be the first company to get there. They're going to obviously be able to severely undercut the competition on price because they don't have to pay. They've got no drivers. They don't need drivers. And they're going to have that. I estimate, and what Tesla say, they think they're at least kind of 4 years ahead of the competition. So,
oh wow,
yeah, and they say that it doesn't really matter. Like they're never going to be caught because in 4 years' time they're going to come out with autonomous software that's 3 times as good. So it's unlikely they're going to be caught anywhere in the near term. So I feel like Tesla's just going to put them out of business. But that's just me.
Yeah, I mean the ride-hailing industry, I mean, it's obviously brand new and the idea is fantastic that Uber brought, but what else does Uber bring to the table, really? Is there anything that's sort of, proprietary to the business that, as you say, Tesla couldn't do and couldn't do better because they've got their, they're a car business and they have these autonomous cars potentially in the future that will just be able to provide a much better service and a much cheaper service. And then you've got something like Google with their Waymo, although I think a lot of Tesla fans would say that Waymo's a joke, but
it is a little bit, but they're competitors.
I can see this market becoming very competitive because it's a market that is very big in terms of the amount of revenue, but no one's really tapping into it yet. And once there's, as you say, autonomous taxis, it's very cheap to provide these rides, and I think that'll bring a lot of demand. A lot of people, even though Uber's quite cheap at the moment, there's a lot of people who just think it's not really worth it, that it's kind of a waste to pay $10 just to go down the street. But if it's $3-4, then it starts to become a no-brainer.
And the other problem with Uber is that they don't make their own cars. They don't make electric vehicles, and electric vehicles are going to be the way to go in terms of autonomous ride sharing in the future because the cost to run them is so much lower because of the servicing costs and the fuel costs. So the estimates at the moment, this is not accounting for improvements into the future, but the current estimates now is that the cost of ownership, or the cost to run a Tesla autonomous vehicle on this network, is going to be 18 cents per mile, which is like crazy considering.
Wow.
I think like Uber is, or running like a conventional car I'm stretching my knowledge here, but I think it was something like between $2 or $3 per mile, or something like $2. So it's like, it's a no-brainer. And you can argue it so many different ways. Like, for instance, like we even talk about Waymo. Waymo they think it's valued at something like closer to $200 billion or something like that, which is like 4 times the size of Tesla. It's like 4 times the market cap of Tesla. And Tesla has by far the best autonomous driving system, and they've got 99% of the data, autonomy data, from the real world. So it's just like, anyway, it's crazy. Anyway, shall we move on to the next news topic?
Yeah, let's do it. This is one that you wrote down, so
I'll go. I just pinched this because I just saw it come up on the news website. So the tariffs between the US tariffs on China have come into effect now. So basically, the article just read that US President Donald Trump's tariff increase to 25% on $200 billion worth of Chinese goods has taken effect, raising tensions between the US and China as they pursue last-ditch talks to try and salvage a trade deal. With no action from the Trump administration to reverse the increased US Customs and Border Protection, impose the new 25% duty on affected US-bound cargoes leaving China after 12:01 a.m. US Eastern Time on Friday. So, I don't really follow this stuff all like too much. Of course, with the way we invest, we're just about individual businesses. But I just thought that was interesting that the tariffs that we've been talking about have now actually come into effect.
Yeah, I mean, it's significant. 25% is a huge tariff, up from 10%, I believe it was, for the goods that these are taxed. There was already some goods that were taxed at 25%, such as steel and aluminium.
Yeah.
But yeah, it's a significant increase in the cost for a lot of businesses, at least in the short term. Whether or not these tariffs stay over the long term, I mean, who knows? Like you say, we don't really follow this. We're not experts in tariffs and trade war. But it is interesting, and it'll be interesting to see how it develops and whether or not there is eventually a deal, because it's been so long now, 18 months that they've been so negotiating?
Forever, yeah. The thing I find really interesting about this tariff situation is how Trump advertises it. So he tries to advertise it as something that's really, really good for America. But at the end of the day, a tariff just means the citizens of America lose, because it makes products more expensive. Because the way it works is it makes Chinese goods coming in, which are usually cheaper than the US built products, it makes the Chinese products coming in more expensive. So what you get, what people like to think is that by making the Chinese products more expensive, it means that the US products seem cheaper, so more people buy US made products. But what it actually means is it just means that the US companies see an opportunity to raise their prices without having a negative effect. So in fact, it actually makes the Chinese products more expensive, but it makes the US products more expensive as well, because the US companies just raise their prices because they know that they've got the price advantage now, so they can bump up their prices with no catastrophic effects, because the law is keeping that advantage for them, so they just take advantage of it. So at the end of the day, it just makes the US citizens have to pay more for their goods and services. So, but it's interesting when you look at how Trump has portrayed this situation. He's very much taken the classic patriotism line of, China has taken advantage of the USA for too long, and we're going to correct that and get on board because we're all about the USA and we're about American business. You never hear him say, by the way, this means that the products affected are going to become more expensive for you, and you're going to have to fork out more money to get the same products.
It's it's going to be interesting to see how this develops. I mean, it's certainly hurting Chinese stocks at the moment.
Yeah.
To be expected, and I think it's probably having a negative impact on the broader US market, I would say, in general. I'm not too sure how this affects the Australian market. I guess it really doesn't at all. But yeah, as you said, we're not really experts in this, and it really doesn't matter. Just look at the company level, look at your individual businesses, and this will be relevant if some of the individual businesses that you hold are going to be affected by this. But you can start to form a hypothesis as to whether or not this is going to hurt your business over the long term, or whether it's really just a short-term thing where your businesses need to change their suppliers around so that they can get better deals or something like that. But should we move on to the final story that we've got here before we jump into the Warren Buffett stuff?
I just chucked this in because it just popped up on my newsfeed on Facebook. This isn't actually like a proper story. I just wanted to kind of highlight this, just to highlight how the media can portray different scenarios to still make them negative.
Fake news.
Yeah, exactly right. So I wanted, this is again, I won't spend too much time on this. So this is about Tesla, right? So the report reads, Morgan Stanley says it's now too easy to own a Tesla, and that's hurting the brand. Tesla may have a price to pay in terms of eroding scarcity value, Morgan Stanley analyst Adam Jonas said in a note to investors on Friday. So just looking at this, it started out way back when. It's gone from, Tesla's sales are down, the demand is gone, and that's going to kill their brand. And now it's gone to Tesla's sales are up. It's now too easy to own a Tesla, and that devalues the brand, killing the future demand. It's so dumb. It's so dumb. And I hate the fact that uneducated people get so heavily influenced by this stupid stuff. It just kills me.
What does that... There's just no... Who in reality can say that the scarcity has been eroded for Tesla? There is... It's just not reality.
Yeah,
if you compare that, that's like saying Tesla's now like a Toyota or something.
Exactly.
Like they're everywhere. They've lost their scale. No, they're not everywhere.
Yeah, the only area that I would say that argument might be valid is if you said something like Lamborghini has now released a hot hatchback that's only 20 grand, and that's eroding the scarcity value or something like that. Because Lamborghini has just got that classic reputation of just being only luxury brand, like an only luxury car brand. But it's just it just shows you the two different ways. We need to write something negative about this company, or we need to write something negative about Tesla. Tesla's sales are down. Oh, we'll just write that demand is gone and that the company's doomed. Maybe now that the sales are up, we still have to write a negative article. So let's say that, of course, now there's heaps more Teslas, it erodes the scarcity value, and that's going to hurt their brand. It's just what the hell are you talking about?
It's really weird because there's so many of these analysts, and this is literally their job.
Yeah.
Their job is just to form an opinion on a stock and then just go as far as they can to prove that opinion, whether or not, it's even true, and whether, writing articles like this. It's a strange world.
It's
really
weird.
That these people like Adam Jonas.
That
these people exist. It's
good on you, Adam.
Good on you, mate. You're doing real changes in the world.
Good on you,
making a real difference.
If there's one thing that I hope to get across to people in my whole whatever span of a career this YouTube thing turns out to be, it's that if you're stock market investing, don't listen to other people. Just don't do it.
Yep.
Just listen to your own research. Anyway. Rant over. Do you want to get into second section now? We just power on.
Let's do it.
We've got section 2 of the podcast today is, as we were saying before, Warren Buffett investing principles and quotes to live by as a long-term investor. So essentially, we just gathered all of the best quotes and we're just going to have a bit of a discussion about them. So the first thing that I wanted to jump into is this quote, and I think this is a really good way of opening this kind of discussion up. The first quote, which I really like, is Warren Buffett saying, it kind of sounds a bit arrogant, "I always knew I was going to be rich. I don't think I ever doubted it for a minute." But it's when you break it down a bit more, it's not actually very arrogant at all. Essentially, from Warren Buffett, he always knew right from the start that the way that he approached investing and approached looking at businesses was the right way to do it. Because a lot of the times on Wall Street, like, you kind of have to be successful stock market investing, you have to kind of be a contrarian. And the way that Wall Street is structured is they end up having to be very short-term focused because they're managing other people's money. They've got to, obviously, the money managers have to keep their jobs. They have to prove quarter to quarter that they're worth it. They have to prove quarter to quarter that they can produce results. So Warren Buffett knew. He was like, no, look, that's not the right way to make money in the stock market. All the way from the start, he knew if he followed his strategy of finding really high-quality businesses and then he just stuck to waiting for that intrinsic value or waiting for the share price to be below the intrinsic value, then that was, if he just stuck to that, he might not get rich very quickly, but he would get rich one day.
Yeah, and I think that really applies what you just said. It really applies to business in general. If you want to build a really successful business, you have to be a contrarian. You have to go against what everyone else is doing. You have to do something a little bit different. You have to tap into a slightly different market or approach solving a problem in a slightly different way. And yeah, that's exactly what Warren Buffett was able to do in terms of his stock market investing and also his business ownership, which is really what he does now. Is like he just owns a lot of businesses outright. And the other thing that I take from the quote of "I always knew I was going to be rich," I think it's a very mindset thing. I think if you always run it like sort of you always are thinking the exact same thing, which is I'm going to be rich one day as long as I keep taking steps towards, achieving, building a business, then it really does help you to stay on track and to actually achieve what you're going to achieve. I think mindset is a really strong indicator of how successful you're going to be if you, from a very early age, can be very consistent in believing what you can achieve.
I think that I think I learned this from a book. I think the book was Think and Grow Rich by Napoleon Hill.
Yes.
Have you read that one? It basically,
I've read it,
yeah. one of the key points out of that book was basically talking about how you as a person, you become what you think about. And it makes sense. Like, you obviously think about what you want to think about. And it's kind of weird how they describe it. It kind of just happens that you end up becoming or acting or doing the things that you always think about and the things that you are confident in. Like, for instance, it sounds a bit arrogant, but I kind of feel a little bit the same as Buffett. Like, I always think about stock, like I feel like I'm very confident in this strategy of stock market investing and my kind of approach to the way I'm running different things in terms of business, that I feel like I've just got to keep thinking about it and, I don't know, just kind of keep chipping away and eventually, just with that mindset, things will start to happen. I don't know. It sounds arrogant, but I kind of don't mean it to be.
No. I think I'm probably in the same mindset. I've always just known that, and I always just keep telling myself, one day you will build something, you will build a business that's going to be really successful. And it's just something that I've always believed. And from when I started saying that, I had absolutely no business, no idea what I was going to do. And now I'm a little bit closer. Yeah. So I'm just going to keep doing that. And that book's really interesting, that it very focuses on mindset and how whatever you're thinking about a lot, whatever you keep drumming into your mind is really how you perceive the world. And it's really sort of dictates what you go after. Yeah.
Yeah, so overall, I always knew I was going to be rich. I don't think I ever doubted it for a minute. It's a really strong Warren Buffett quote. It goes back to, he knew that strategy of finding really high quality businesses and buying them at a price below their intrinsic value, that's what he needed to do. He had full confidence in that strategy, and that's what was going to get him rich. And that kind of leads into his next quote, which we're going to talk about, which I'll leave to you. Price is what you pay, value is what you get.
Yeah, this is probably one of my favorite ones from him because it's so simple, yet it exactly defines a significant part of his strategy and a significant part of what really should be everyone's investing strategy. And that's that the price of a stock doesn't always equal its value. So the way I see it is that value can be defined as how much cash we're going to get out of the business while we own it. What value is it going to bring to us? And in terms of an investment, the value is how much cash we're going to get back. And really, we can break that down into we're going to receive dividends. So we're going to receive cash payouts from the business throughout while we own the business. And then also at the same time, the business may reinvest some of their profits and become more profitable, generate more cash flows, and that will increase the price of the business because its long-term value will go up, so its long-term price should go up.
So either dividends or capital growth.
Yeah, exactly right. And I mean, in terms of price is just simply the last price that someone paid for the stock. It really, while it does, of course, take into account the value, it has to take into account value. It also takes into account other things, such as short-term problems and emotionally driven decisions by investors who are affected by something in the short term.
The way that I look at it, right, is so price is what you pay, value is what you get. So say you had like a $1 coin as a bit of an example, like a $1 coin. In wherever you are in Australia, a $1 coin, its value is $1, right?
Whoa.
But if you, I know.
Insights by Brandon.
groundbreaking stuff here. But if you think about this $1 coin as a business, a stock on the stock market, then what happens in the stock market is that every day people will wake up, they will walk up to you and they say, hey, I see you've got that $1 coin. I'll give you 80 cents for it. And then another person might say, no, I'll give you $1.20 for it. I'll give you $1.10, or I'll give you 95 cents for it. I mean, that is the share price, that example. That's what the share price is. It's just somebody standing up and saying what they are willing to pay for your $1 coin. But the value of your $1 coin is $1. Now, of course, this doesn't directly apply to business because obviously business, the value can change and hopefully it slowly grows over time. But the value generally in just slowly growing, steady, high quality businesses, the value goes up slowly over time. Okay, so a lot of the times when people are shouting, I'll give you, $1.20, no, I'll give you 50 cents, no, I'll give you $5, I'll give you 20 cents. It's just the price fluctuates very like crazy. And it can fluctuate like crazy in a very short amount of time. But really, you have to just come back to looking at what is the value of the thing that you are looking to buy? What is the value of that business? Because overall, price is what you pay. So what we've got to do is we've got to figure out the value of the business and then wait for the price that is being shouted at that time, on that day. We have to wait for that price to be lower than what the value is.
Yeah, absolutely. And of course, part of that means that we need to be accurate in calculating how much it's worth. Because of course, in the dollar example, it's $1. But when it comes to a business, it can be very subjective. I mean, not subjective in the way that it can differ, but no one knows. But it can be a bit of a
range. Yeah,
exactly.
Within, it might be, say, I don't know, it might be $150, it might be $160, $165. It's in that range. It's not a definite. This is worth $156.20.
Yeah, because as I said earlier, value is how much cash we're going to get back in the future. And of course, we can't predict the future. At least I don't think. Can you predict the future, Brandon? Can you?
I gave it a go once. It didn't really work out.
Okay, yeah. So we've settled that. Can't predict the future. So we don't know how much we're going to get back. We can only estimate. And it comes back to buying those really stable businesses where they're very predictable and not buying Uber IPO.
Exactly. Yeah.
Because, we don't know how much we're going to get back. And the range of how much cash we could get out of Uber is just huge.
Who knows?
Could be nothing. It could be a lot.
Could be nothing, could be everything, but we don't know, and that's the thing. We don't know. We can't. There's nothing about it that means we can be any version of the definition of accurate.
Yeah, and speaking of speculative investments, the next quote from Warren Buffett is: rule number 1 is never lose money, and rule number 2 is never forget rule number 1. Yeah.
So this is basically like, we go back to the first quote we're talking about. I always knew I was going to be rich. I don't think I ever doubted it for a minute. I mean, rule number 1, never lose money. Rule number 2, never forget rule number 1. I mean, it starts by just the idea, this is really focusing on the idea of like speculating versus investing. If you're investing, if you're finding good quality businesses in good financial positions and you're buying these shares when the price is significantly lower than the share value, then that is how in the stock market you don't lose money, okay? You lose money by taking a guess when you're just like trying to invest in something and you're not sure. So it's something like that Uber IPO. We're not sure. So that would violate this rule number 1 because there's a potential that we'll lose money. I mean, if you make it consistent that you buy high quality businesses when the price is lower than the fair value, you don't lose money in the stock market. And that's the thing. There's basically just saying don't speculate, invest. That's basically what this is saying. So set yourself up so that you first and foremost do not lose money. There's absolutely minimal downside, and then there's heaps and heaps of upside. And then rule number 2, never forget rule number 1, because a lot of people just maybe I'll just take a chance on this one, but just don't forget it. Don't forget rule number 1. What do you reckon?
Yeah, spot on. And I think it's possible to misinterpret this quote. And some people may say that this means you should never have a negative investment, an unrealized negative investment. So you buy a stock at 50 and it falls to 40. You think, oh, I've broken Buffett's rule. I lost money. But that's not true. And it's impossible for you to always pick the bottom. And you shouldn't. There's no system that allows you to do that. So don't ever try and do that.
No.
As you said, what he means you buy businesses where at the very least, you're going to get back what you initially invested. And Benjamin Graham calls this safety of principle. It's one of his key elements of what he would call an investment versus a speculation, is that you need to have a safety of principle. And then what was the rest of it? That you'd get a satisfactory return?
Yeah, something like that, yeah.
So yeah, I mean, the way that we do this is that we do that calculation of intrinsic value. We do an estimate of how much cash we're going to get back, and we're doing this on businesses that are very consistent, so that we can be conservative in our valuation and be confident in our valuation because they have a great management running, they're making their decisions, and they have an economic moat, some kind of competitive advantage. And then we buy with a margin of safety. So we never buy at intrinsic value. We always buy with a margin of safety to allow for the fact that, yes, maybe the business doesn't perform as we're going to expect. But if we buy with that 50% discount, then we're even more likely going to get back at least our investment. And then, of course, we want to be investing in businesses that have a significant upside opportunity.
Basically, invest when there's minimal downside and a lot of upside. Yeah, and then overall you'll come out on top, because if you do this with a couple of different businesses, I mean, really, if you've got that margin of safety on a really high quality business, if you buy in and the stocks go down, if it's a high quality business and if you know you're at that margin of safety and the stock goes down, then that makes you feel better. That doesn't make you feel worse. Like for someone that doesn't understand the business or is in a company that's not high quality, then when the stock price goes down, then they're kind of sweating a little bit. But if we invest in a really solid business with really good competitive advantage, good management team, and we know we're getting a margin of safety price, then if the price goes down further, then that is awesome. Because as another quote, I don't know, I can't remember if Buffett said this or whatever, but if stocks go up, you make money, but if stocks go down, you get rich. So I can't remember if that's one of his or someone else's, but yeah, totally just like, it explains that situation pretty perfectly, I reckon.
Yeah, and that really relates to the next one. I mean, I guess all of these are related because they're all Warren Buffett's and they're all his principles.
Yeah.
But the next one we've got here is, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
Yeah, and this quote speaks mainly to his first concept of value investing. You have to start off with really high quality businesses. So overall, it's really step number 1. It's about the business quality. So that's why he says it's much better if you find a really good business with like a really good competitive advantage, a really strong financial position, and you can buy that at just a fair price. That's going to be a far better investment than buying just like some mediocre company that's just at this absolute bargain basement price. Because basically with high quality businesses, they have, because they're high quality and they have a really strong financial position, they're able to recover from anything that might get chucked at them. But if you're in just this mediocre business at just an amazing share price right now, like, oh, it's so tempting, but it's only a mediocre business. If something bad happens to them, you're not sure that business will be able to recover. So overall, it's about, rule number one, don't lose money. It's about finding high quality businesses and making sure you stick to those, even at a fair price. And I think Ben Graham even says that in his book, The Intelligent Investor, if you're looking at these really mediocre companies, then the only way that you can really buy mediocre companies when they're at just bargain basement prices is if you buy a lot of them and you're kind of diversified. So that, yeah, sure, a couple of these mediocre companies in hard times where their share price is really depressed, a few of them might go bust. But probably if you can buy like a whole range, if you can buy like 20 or 30 or 50 of these companies, these mediocre companies at really crazy good prices, that's probably the only way to approach that, so that overall you can probably still make some money, because probably more often than not those companies will recover. Like a few might go horribly wrong, but a few will probably do pretty well. But overall, it's just like, it's not worth it. I mean, it's just much better sticking to what you know, finding really strong companies in your circle of competence and paying a fair price.
Yeah, exactly. And the way I see it is that when a stock goes down, so we're looking for businesses that probably have a pretty dramatic drop in their stock price so that we can pick them up at a discount.
Yeah.
And really the reason why a stock's going to fall dramatically is because something is hurting the business, at least in the short term.
Yeah.
And then it's whether or not the business is great is going to be a determining factor in whether or not that stays a long-term problem and destroys the value of the business, or whether or not they're able to recover and go back to the profitability that they were before. So it is definitely a fundamental key that you need to be buying really solid businesses that we define as ones that are within our circle of competence, so we can understand what's going on. They have a competitive advantage that's intrinsic, that's unique to the business. They're run by management that has skill and is transparent and honest with us. And if you meet those criteria, then those kinds of businesses might experience something that hurts them for 6 months or 12 months or 24 months. But after that period of poor profitability or problems happening, they are probably going to return to experiencing the same levels of profitability or more than they did in the past.
Yep, basically, yeah. So definitely better to buy a wonderful company at a fair price than a fair company at a wonderful price. That's probably one of my favorite quotes out of Buffett. I mean, I like all of them, but that's probably one of my favorites. Moving on, the next one we've got is, we simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. Did you want to talk about this one? This is such a good quote.
Yeah.
It's so simple. It's just so simple.
It is.
It's about being the contrarian.
Exactly. And that's exactly what you need to do if you want to be successful in the market. If you want to outperform the market, you have to go against the consensus, because the consensus is the stock price. If a stock has fallen significantly in the short term, then that is the opinion of most people. So if you want to make money, you have to go against that, and you have to buy it when a lot of people are selling. And really, stock prices move in the short term based significantly on emotion.
Yep.
So a stock might have momentum and short-term positivity behind it, and as a result, its price can exceed its value when investors get really greedy. And this is actually the time when you would want to be selling, according to the quote. You want to be fearful when others are greedy, meaning you want to sell your businesses to someone for more than $1 when they're worth $1. So if you have $1, you want to sell it to someone for more than $1, because their short-term greediness of the market and the emotions and the momentum, and maybe there's some short-term positivity that's pushing the price up. You want to sell to people who are getting greedy, who are paying more, who are willing to pay more than $1 for $1.
Yeah, exactly. Yeah, like for instance, right now, it's not a great time to invest. Like I don't like we're in some of the best economic times. If you look at the stock markets, we're in some of the best times ever. Well, we're in the best time ever in history. The stock markets are pushing all-time highs across Australia, across like the US, or actually more so the US, but the Australian market's still high as well. But I don't like it. It's like, I don't like it, because it means in these sort of conditions, the stock market just keeps powering up and up and up, and that fuels people's greed. So right now, I'd much rather be a seller. What I would get super excited about is if we woke up tomorrow and the market started crashing. I remember I watched some TV interview of some stock market investor that follows these sort of strategies. This was years ago. And the TV presenters were laughing at this guy, because this guy was saying, look, I'm an investor. If I could have my way, I would make the stock market crash tomorrow. That would make me the happiest person on the planet if I could make the stock market crash. And then all of the presenters, because there was just this one guy that they were interviewing, all of the presenters, like 4 or 5 presenters, just started laughing at him. And they started sniggering and making jokes about him and that sort of thing on the air. But it's so true, because you want a situation where you've found your really good quality businesses, because even if the stock market crashes, a good business is a good business.
Yeah.
So you want to be able to have those times where everybody is really fearful. They just do not want to touch stocks. So obviously, there's unfortunately 2 ways to look at it, like a recession or a crash, is that a lot of people do get financially hurt. So you don't obviously you don't want to see it, because people do get financially hurt by them. But at the same time, if you just look at your own personal position and look at, trying to make money out of good quality businesses, you really want stock market crashes, recessions, that sort of thing, because it gives you, if you're going to be a net buyer over the next 40 years, you want prices to be as low as possible, as early on in your journey as possible.
Yeah, and it comes back to that price is what you pay, value is what you get. When there's a lot of fear in the market, when the market is falling, then the price you pay can often be significantly less than the value that you're getting, just because because the general market is very fearful about the consequences of the next 6 to 12 to 24 months, because maybe there's really negative consumer spending. And there's negative GDP growth, and people are just saving their money and not spending. So people say, I don't want to own businesses while there's going to be less customers than there was last year. And people sell all their stocks. And then the smart investor like Warren Buffett or any other kind of value sort of investor can come in and see, well, consumers might not be spending this year, but the stock is cheap and they're likely going to go back to spending next year and the year after, because it's a great company. And the same can be said on the flip side. When people are greedy, they're often willing to pay more. The price that you pay is often more than the value you get. And that's definitely the case at the moment for many businesses. And go on.
I think, I was going to say, I think one of Warren Buffett's first ever true investments was actually he bought a farm. And the reason he bought this farm grew, I think it was corn. And at the time that he bought it, the price of corn, the going price for corn was absolutely terrible. It was a short-term thing. There was just I can't remember what caused it. I think it might have been, I don't know, like weather patterns or something like that. But it was meaning that this corn was just doing so terribly. But he decided to buy the farm, because he knew that the farm itself, this is a physical asset in the real world, he knew that had a moat, because the area that he bought it in had consistently over decades higher than average rainfall in that area and really rich soil. So he knew that even though the corn price was terrible and the crops that he was making right now couldn't be sold for any sort of good profit margin, he had a moat in where that farm was located. So he decided to buy it, because he knew that this was a short-term thing, it'd blow over. And sure enough, he bought it. He got other people to manage the farm. And then in a couple of years' time, whatever was causing that corn price to be horrible and causing a lot of farmers to need to sell, that just blew over. And then all of a sudden he's left with this amazing asset, this rich, fertile soil with really higher than average rainfall. And he's making heaps of corn and he's selling it on. And the price is normalized. So he's making really good profits. So it's a kind of more of an interesting real world example, but with the same principles of stock market investing that he follows.
Yeah, and that leads us perfectly into the next one, which is the next quote, which is, risk comes from not knowing what you're doing. And Warren Buffett clearly knew a hell of a lot, or he knew exactly what he was doing when it came to that farm. He knew that it was a short-term problem, but the price was significantly cheap relative to what he was going to get in the future.
Exactly.
Did you want to run us through this quote and tell us what you think it means?
Yeah, risk. So risk comes from not knowing what you're doing, and in stock market terms, this is basically the anti-diversification strategy. This is what Warren Buffett. He's basically saying here that his style of investing, which is doing your research and investing in individual businesses, look, that's his style. So risk comes from not knowing what you're doing. So if you don't do your due diligence, if you don't research into a company, then you can't be sure that you're making a really good investment. That's when you start speculating, when you don't understand the business. And that's where you start to introduce a lot of risk into your investing. What else was I going to say? So for a lot of people that maybe don't have the willpower to actually start taking their time and researching into individual businesses, like, it's totally okay if you just want to try and participate in the market and get the average market return. In that instance, you want to try and diversify across the whole market as widely as possible. But for people that want to make quite substantial sums of money in the stock market, you need to be able to just analyze and pick individual businesses. So the only reason that risk comes into play is when you don't know enough. So if you really take the time to look at your circle of competence and understand it, then you know, and you can understand those businesses, you understand their valuation, then there's very little risk in actually investing in individual businesses.
Yeah, and risk is really, the way I see risk is that it's essentially uncertainty. So when it comes to businesses, the uncertainty is the uncertainty about how much cash we're going to get back from it. And your ability, if you really understand a business, like Buffett understood that farm, he knew this is what the yield is right now on the corn, but in 2 years' time, there's going to be heaps of rainfall because that's what it is in the area, and the price of corn is going to go up again because people are going to be buying it, or whatever it is, the weather conditions have cleared, or whatever the problem was.
Yeah.
He knew exactly how much he was going to get out of it. So there was very little risk. And that's really the important thing. If you're buying individual businesses, then understanding exactly what you're doing, understanding the business, and understanding how much cash you can conservatively expect to get back, that will significantly limit your downside risk.
Yeah, and then the last quote that we've got here that I wanted to run through specifically was, only buy something that you'd be perfectly happy to hold if the market shut down for 10 years.
Oh, this is a good one.
Yeah, and basically this is showing that obviously Warren Buffett always invests for the long term. You buy high quality businesses, and then you have to go in with the mindset of holding these companies for a very long period of time. Because essentially that's where the money's made. You know you're going to make money if you can buy good quality businesses, buy them below price below intrinsic value, and then you hold them for the long term, okay? And the most important thing to be able to hold it for the long term is to make sure that the business is high quality, so good moat, good management, that sort of thing. So, because obviously in the short term in the stock market, anything can happen. Like, you could be in a really good business, and short term in the stock market, like over the next month, the next year, it can still go down. And this is I love, this is another quote from Buffett: our favorite holding period is forever. So ideally, you never sell your stocks. Like, Warren Buffett he really thinks about buying stocks as being the business owner. So ideally, if you own a business, you just want that business to keep improving and improving and improving so that you never have to sell it. I mean, really, you sell your business when you can see the future and you're like, look, I should probably get out now. I should probably take what I've already got and get a good price for it.
Yeah, like when some Uber private investors have seen the end of the line, so they take it public and get out.
Yeah, basically.
Slight dig.
Yeah. But yeah, essentially, like, our favorite holding period is forever. You really just don't want to be caught up in the speculation. You don't want to be caught up in what happens month to month or even over the next year in the stock market. Just always go for the long term. So essentially, another Buffett quote is, the stock market is designed to transfer money from the active to the patient. So all of this short-term stuff that, gets chucked around, buy this stock because the indicators look green and it's going to go up and that sort of thing. That's not the game that we're in. That's not the way to make substantial sums of money out of stock market investing. You've just got to be patient And what's the other quote I've got here? Calling someone who trades actively in the market an investor is like calling someone who repeatedly engages in one-night stands a romantic. So it's pretty funny. It's just always just stay long-term focused. That's where the money's made. Find high-quality businesses. And that's the key, because if you find high-quality businesses, the idea is that if you can buy them at a share price that's below intrinsic value, you basically won't have to sell them because the business should still be really, really good.
Yeah, and a significant factor that impacts most people's returns in the stock market, whether they're investing with a fund or individual stocks or an ETF, is their emotions. They see the stock market moving and they make decisions. I think one of the more dramatic examples of this was Peter Lynch's fund, which returned 29% over, I think it was a 20-year period or something like that. But the average investor in that fund lost money. Because every time that he was buying a lot of stock, all the stocks were down, because that's how you be successful over the long term. But when he was buying a lot of stock when it was down, all the investors were like, what the hell are you doing? And they got out and they moved on to the next fund manager.
Suckers.
And the exact opposite happened. When his fund was doing really well, when it was experiencing all of the positivity from him buying the stocks really cheap earlier on, heaps of people piled in. So they bought high and they sold low. And this is why I personally think that the best investment most people will make is a real estate investment, because you just can't be emotionally affected by it. You can't sell it. And for that reason, it keeps your emotions out of it. But it really is possible for you to invest in the stock market without being emotionally affected. And it is exactly like following this quote. Just invest as if you can't sell it. Yep. Just convince yourself that you can't sell.
Yep. Stay rational, folks. Stay rational.
Stay rational. And on that note, let's get into some Q&A, I think.
This is a great Q&A question to start right after we start talking about Buffett quotes. This person is saying they're learning to trade stocks and they wanted to know our opinion on stock market trading. Well.
Rewind to the beginning.
Rewind about 10 minutes ago and play it again. No, like, obviously we like long-term investing. Some people like trading. I'm not saying that, there's anything. I'm not saying that stock traders are, scum of the earth or anything like that. Like, a lot of people make a lot of money by trading stocks. And I don't deny that, some people can do it very well. For me, I don't want to put my money, I don't want to invest or speculate like that. So overall, I don't know a huge amount of trading. All that I know is kind of some basics on kind of looking at different kind of technical indicators of where it's more likely that a stock will trend up or trend down over the short term, just because you can track the flow of the institutional money in and out of stocks. And of course, they have to move slowly because they can't. They essentially, it's a kind of a long process, but they manage so much money that if they invested all that money in a stock they really liked, they have enough money that they could drastically spike that share price by investing all of it at once. So they have to invest in smaller sums and do it over a period of weeks to try and get in at the price they want to get in at. And overall, you can kind of track that with the MACD, the stochastics, the moving averages, and putting all these indicators together. If you want to read Rule 1, it has a good section on these indicators. But overall, like I just don't try. I don't try and prove to anyone that I know anything about trading stocks.
Yeah, I mean, trading. Well, essentially, when you're trading, you're just trying to predict price patterns. And if you're comparing trading to long-term investing, the price that you pay matters so much more when you're trading, because you're looking over a shorter period of time and you're trying to make a profit over those price movements. Whereas a long-term investor, honestly, if you're buying a really great business and you hold it for 10 or 20 years, and it's still a great business over that time, the price you paid between paying $100 per share or $70, it isn't going to matter to your long-term return. Whereas if you're trying to trade out of that stock in a month, then the difference between buying it at 70 or 100 matters if it's going to go to, say, 110, because you're not going to make a lot of profit if it just goes up 10%, but if it goes from 70 to 110, you're making 50% or more. So, I mean, obviously people do it successfully, as you said. But for us, I think a much more rational strategy is to buy the underlying business and hold it for as long as possible. And I think that's probably the easier strategy to do successfully, consistently.
Takes less of your time, That's for damn sure.
Definitely.
That's the thing about traders. They literally got 5 monitors going at the same time. They're tracking this, and they're sitting there. They're literally working a full-time job. They're sitting there from 10 to 4 when the markets are open. They're just like trading. It's just like, I don't want to have to do that. I want
would be
my
so
investments.
stressful.
I know. I just want my investments to be churning away over time, making me good returns, and I don't have to stress about them. I maybe check on them every week or two, and make sure I just keep reading about them. But I want to be able to go and play tennis or go to the movies and not have to sit in front of my computer screen the whole day. Anyway, next question we've got here is, what are your thoughts on Coles? Do you have any thoughts on Coles? I only have very minor thoughts on Coles.
Yeah, so Coles, if you don't know, Coles was a part of Wesfarmers, which is a kind of a conglomerate that owns a bunch of different things. I think they own, what do they own? Kmart?
There's like, you've got
Bunnings.
Woolworths and Wesfarmers, and I think Woolworths is Woolworths and Big W, and I think Kmart is Wesfarmers, and Bunnings is Wesfarmers, and Coles was Wesfarmers.
Yeah. So Coles now is separate from Wesfarmers. So Wesfarmers owns about 50% of Coles, but Coles is its own company on the stock exchange. And it's a supermarket. If you're not from Australia, it's a supermarket. And there's basically 2 major competitors, Woolworths and Coles. They dominate the market. Personally, I mean, I'm definitely biased here because I worked at Woolworths. But I just think Woolworths it has a much better brand than Coles. So from a brand's perspective, I would say that. From an investment perspective, I mean, it's a very stable business it's one of those businesses that is very defensive. People are going to be buying it. People are going to go do their grocery shopping regardless of the economic condition. So their earnings are probably going to be pretty consistent over time. But yeah, in terms of whether or not you could buy it at a good price, I don't know. I haven't looked into the price of it at the moment. So I couldn't give a comment on its price.
Yeah, I've literally just written down dot points here. I wrote consumer staple, blue chip company, defensive, no moat, depends on what investor you want to be. So, I mean, for some people, they're perfectly happy just parking their money in defensive stocks and leaving it there for a long time. But for me, I like companies that have growth potential, and I like to see competitive advantages and that sort of thing. So for me personally, my strategy, Coles is not a company that I would particularly look into. All right, here's the next one. On the spot, do you think we will see a recession or crash in the next 12 months?
Oh, that's a good question. Firstly, I'll say I don't know.
But we'll give the political answer. We'll give the political answer first.
Yeah, so...
We can't tell.
Yeah. Well, let me tell you a story. No. So don't know, no idea, no way to predict it. But if I just had to make a guess, like you forced me to make a bet, I'd say yes.
Yeah, I'd agree. I mean, that's basically like, you can't predict when it's going to happen. What you can look at is you can look at some general market indicators as to whether it's more likely to happen. Like if you look at the Schiller PE, it seems unsustainable above 30, and it's like at 31 or something like that. If you look at the like market cap to GDP measures, it's unsustainable above 100%, and it's substantially above 100% at the moment. So generally, history suggests that when these indicators go above those kind of levels, then it's kind of unsustainable it might last maximum like 12 to 18 months. But having said that, like we've seen those indicators be horribly high for probably more than 18 months now. So we're just pushing new ground here, but it doesn't change anything. Like the stock market's still really overvalued. So I couldn't predict whether we will see one or not in the next 12 months, but like you, I'd say probably.
Yeah, and in terms of how this works is really it just depends on interest rates. So as you said, the Schiller PE at the moment is 30. Is that right?
I think so, yeah. It's above 30 at the moment. Yeah.
So what a PE ratio is, if you just invert that, it basically means that the stock market at the current earnings is offering a 3% earnings yield. So the return that you're going to get from the broader market is 3% plus growth, right?
Yeah.
And in the past, growth has been huge. I think it was double digits last year. But this year, it's been relatively flat. It's been low single digits. So you're getting a very low return on stocks. And the reason why it's low is because prices are really high. And because the alternative, which is the risk-free bonds, are at 1.5%. They're extremely low. Bonds are at 2 or 3%. But the thing is, it really won't take too many of those interest rate hikes if inflation picks up and they have to increase interest rates. It won't take too many of those before bonds look really attractive relative to stocks, because they're risk-free and because they're probably going to offer in the 5% range maybe, and then stocks are offering 6 or 7%, and suddenly those extra 2% are really not worth it. And all it would take is for interest rates to rise. If interest rates double, then you could see stock prices half. So I think it's very sensitive at the moment. But as Warren Buffett said in his interview, we might see a prolonged period of low interest rates. So maybe then stock prices are justified. But we really don't know. It really depends on what happens, how much growth picks up and how much inflation picks up, and things that are really out of our control.
Yeah, exactly right. I mean, you just have to wait and see if it happens. Should we wrap it up there?
Yeah, let's wrap it up there. Thanks everyone for listening once again. And of course, if you have a question or a topic, then let us know. Leave it in the comment section below the YouTube video, youtube.com/Hamish Hodder. And yeah, thanks for listening once again, everyone. Thanks for joining me, Brandon.
That's all right.
But I guess we will see you guys next week. See you later, guys.
All right. Bye-bye.
See ya.